Hello there, everyone. Welcome to another edition of Tip Tuesday. Geoffrey Nance here with you. Wanted to talk to you a little bit about some different strategies that are available to you and how you can think through those and how you might need to adapt depending on your lifestyle and your work situation and what that might look like and the availability you have when it comes to timing the market. So there is a thing called buy and hold, and that is what most people would do if they don't really know what they're doing and they don't really have a chart and they don't really understand movement and patterns and all that stuff. They would simply buy a stock because they either like the company or they saw that it was growing and there were more of them popping up all over the place and they're like, sounds good. I want to go buy that thing. And by the way, you can make money doing any of these strategies. The key, though, to buying and holding, where most people really miss, is they don't have any other additional plan. They're just going to buy and then literally just hold. And the issue with that is like owning a painting at that point. It may be increasing in value, but it's not making you any money because you only make money when you sell. So if you were to have bought that thing at a lower price and now it's much higher, it still doesn't matter because you haven't sold. You haven't made any money off of it. But it's a buy and hold strategy and it can work, especially if you do it at the right time. And then there are people that I would call like semi buy and holders. They're going to buy a stock, but they have a willingness to sell that stock. So when it hits a certain price or they've been in it a certain period of time, they're willing to sell that. Now, maybe it's going to be a year at least so they can get the capital gains tax rather than their personal tax rates, but they have a plan to buy a stock and then hold it. But after a certain period of time, they do plan on selling it. It's not like they're just going to hold it forever. And then you would have something closer to what we would do, which is called swing trading in some circles. It's the idea that you're going to buy a stock, and then as it moves from support to resistance, you're going to sell that stock. Now, for someone who has some time, this does make sense. It is appealing because if you can buy and sell and buy and sell, then buy and sell, you have the potential to make more money, obviously, because you're bringing in more income than somebody who's simply buying and holding, or basically buying and holding for a shorter period of time. To buy and sell, to buy and sell, now you're bringing in money each time you sell. So obviously, with what we do here at Tradeway, we're what you would call swing traders, and we're basically trading between the swing forward, the swing backward. So as the stock goes up, we would like to buy it as it starts before it starts to go down. We like to sell it, and so we're just trying to make money on those swings back and forth. That's called swing trading. Now, some stocks move faster than others. There was a time years ago when it might be common for a stock to take a month, 6 weeks, 2 months to move from support to resistance. We don't see that much anymore. The market has become much more volatile, so our swings happen much sooner. And so we have to be in a place where we either do one of two things. We're able to watch the market a little bit closely, and a little bit more closely, I guess is technically the right English. So we're able to watch more closely so that we can get in and out at the appropriate times. Or you say, Geoffrey, I'm not really able to do that because of work. Well, then option number two for you is to begin to take advantage of automated orders. And your broker will have certain automated orders available to you. And for some of them, they might have what's called a bracket order, an OCO, or one cancels the other. And that's applied to where you can go set a stop loss and a sell target. So if it exceeds a certain price, then it sells at that price, or anything higher, If it goes below a certain price, it stops you out at that price or anything lower. And we actually did this in a course I just taught up in Minnesota, and we got into 2 trades, and right in the last hour of trading, and one of them we got stopped out on Monday morning, and the other one it sold at our target, so it moved all the way up, hit our target, and it did that automatically for us. So if you can do an OCO order now, you'd have to check with your broker. Some of them have it available, some of them don't, but that creates an opportunity for you to feel like I can trade. And if it hits this price, it does this. If it hits that price, it does that. It'd be great if they had that available for options and for our debit spreads. That'd be pretty amazing, because we could kind of set it and forget it unless market tone just drastically shifted. Then you could just basically leave that order in there. And the other type of trading that some people do is called day trading. And that's where you get in and out of a trade. So you open the position and close the position in the same calendar day. Now, there is some downside to day trading, because you could get termed a pattern day trader. And there are certain requirements for someone to be listed as a pattern day trader. Like you might have to have $25,000 maintained in your account in order to do that. It is treated a little bit differently. You'd have to have a certain type of account in order to do that. You can do 3-day trades in a 5-day running calendar. So if you do have to get into and out of a trade in the same calendar day, that is a day trade, but it's not a big deal unless you begin to do that often enough, in which case I would suggest switching accounts or just chilling out, buying towards the end of the day so that you can't get out, right? That's another opportunity. So there are about 3 different things you could do if you find yourself feeling like, hey, I'm getting close to my pattern day trading number there. You don't want to exceed that. They can shut your account down. A lot of times they'll give you a warning, put you on a probationary period, and then basically say don't do it again. And if you do, they'll basically shut you out or require that you fund that account to over $25,000. So it's not necessary for you to do that. In fact, we don't want you to do that because we want you to have a little time freedom. In fact, you can do this even if you have a job. Now, if you have a job that makes it very difficult, if not impossible, for you to make the trades, what you are going to have to do is rely more on automated orders and also alerts, right? So alerts and alarms. And then just trying to find time where if your stock hits a certain point, you could go out there either into your computer or onto your phone and just, log into your broker and make a quick trade there. It doesn't take very long, so it wouldn't take much out of your job in order for you to do that, unless you work at a facility where they don't even allow you to have your phones, in which case you would have to obviously begin to rely more on automated orders. So when it comes to specifically swing trading setups, what are some of those things that we do? I'm just going to kind of list those things off for you. So one is a rolling stock. Now that's a stock that's just moving between 2 horizontal price points, bottom support, top and resistance. You're buying low, selling high. The second one is an uptrend, same thing, except now the stock is moving up inside that channel. You're buying low, selling high. And then we have some particular patterns, I think, that are really, really worth watching. One of those is called a flag pattern. You get a big move up, it trickles down, and then it gets ready to shoot back up again. And then there are a number of other patterns. I like to tell people a little bit about exponential moving averages and how to trade from one EMA to the next, particularly when a stock is gaining momentum. You can begin to see that it will travel from one up to the next, but each exponential moving average on top is potential resistance. It'll hit that and fall until your stock has enough strength to break through those. You can think of it like lifting weights. You got a weight on top of you. Are you strong enough to push it off, or is it going to come down and hit you in the chest? So those EMAs on top are acting like those weights to push down on the stock itself. So there are a number of things. I thought we might go out here to the chart. So let me go ahead and share my screen real quick. We'll just go out here for a little bit and kind of take a look at what some of these things might look like and how you can think through them. I'm on Charts by Tradeway. I'm going to research and go out here to charts. And you can see here, we're just looking at Amazon first. Amazon has clearly been in an uptrend. Could we draw lines, support and resistance on Amazon? Maybe. It would be a little tough. We would certainly not be exact, but what we can do is look at our EMAs. This is the 50-day EMA. And over the last month or so, last 6 weeks, anytime it's hit that 50-day, really we can go back to here, even here and there. So once it got on top of the EMAs, anytime it hit the 50-day, it has moved up. And that becomes a viable opportunity for us to buy at the 50-day EMA. Now, Amazon is getting closer and closer to that. Obviously, this week we'll have to monitor what the Fed is going to say Wednesday afternoon, how that's going to impact trading. But this isn't what we would say a pattern necessarily, except if something happens over and over again, then indeed it is a pattern, right? So might not be able to see, straight support and resistance, but you can see the EMAs and you know that it is clearly using those. Apple, on the other hand, is a very different looking pattern. It stayed in between support and resistance from March till August. So March, April, May, June, July, and then into August. That's a long time to stay in the same range. You can see, guys, it never got outside of those lines. It's just a straight uptrend for over 6 months. And, Apple's probably one of the best examples of that for that sustained period over that length of time. But there are plenty of other opportunities. Some stocks are at support. Again, they're rolling stocks and they're moving up. Let me just show you guys an example here of a little flag that happened this week. Now, it may not look like much. I'm going to zoom in here. But you got your flagpole up. It came back down. It hit this line, and then it zoomed back up into resistance. So this is one of the trades we actually did over the weekend. We just got into this trade, and then it stopped us out or sold it when it hit our target up here. So it turned out to be a pretty sweet little, nice little trade there, right? Just a little swing from support to resistance. So support to resistance. And it turned into a really nice trade, still hanging out at resistance today. So, you could find some other things that are, rolling and doing some different things and take advantage of those as well. I'll just point out a couple of stocks here just for us to see some recent examples. RVNC. All right. So this one was at a support area. Again, you can see that it moved back up, hit the EMAs on top. This time it hit the 20-day and used that as resistance. And now today they've got some terrible news. They're down, massively, 31%. That is a massive. Normally you'd see that at earnings. This wasn't earnings related, so it's news related. And what we would want to do here is go up to activity, hit news, and see what is the news on that thing. They had some kind of an investor day, and it did terribly, right? So whatever they revealed there, it was pretty terrible news. So I don't know if we see a whole lot here yet, but it was terrible news there, something they presented at that conference, and it really crushed the potential of that trade, even though it did work really well, and again in the short time. So again, this just kind of illustrates to you, if you did this as a swing trade and bought it at like $15.50 and sold it at $17.50, that's a phenomenal little swing trade. But you're in and out with the volatility. Is the 3-day trade, 3-day, 4 days max, right? 3-day, 4-day trade max. If you're still in that thing, well, now you see it dropping over the last couple of days. Thankfully, you had a chance to get out before it did that to you today. But if you're still in, it's the difference between a swing trader and a buy and holder, or semi-buy and holder. Semi-buy and holder still in this thing. Where those of us that are swing traders, we had the opportunity to get in here and then get out there. That when it hit our target. So that's very different. And I think that's a key there to you guys too, to understand the importance of um, being able to do that. You had a stock here again. It was in an uptrend. Could you draw lines on it? No. When it starts to break down, now you have to change the way that you think about those trades as well. Here's a stock we looked at, and we looked at this one last week, and we said now that it's above the EMAs. Now this is a very particular type of trade, and basically we can see here that it's going to fill the gap. So it's going to come up here, see the gap. That's a movement from where it closed, where it opened. It filled that gap. Look at that. So it just went up there, got slightly above it yesterday, and then not surprisingly, it's falling today with the market being down. So there are a number of things that you can do. And obviously, we're not going to teach all of those here in this session for a Tip Tuesday. We have a number of things that are available to you. But I like to tell people that it's a little bit like being in a big city and trying to catch a bus. Well, there are buses running all over that city all throughout the day. So whether or not you catch a particular bus has everything to do with whether or not you know when that bus is supposed to be at a particular location at a particular time. So in other words, we've looked at a bunch of different strategies, but whether or not you were able to enter any of those trades and make any money on any of those trades has everything to do with whether or not you understood what the expectation was, what the pattern was, what your entry should be, what your target should be, and where your stop out should be. So that comes down to education. The more you guys are invested in what we're doing, the more we'll talk about these things and make these patterns available to you. Of course, we talk about them on our Monday night webinars, our study groups, and things like that. That's where we present opportunities like that. And then through our live trading and just a number of things that we have going on all throughout the week, even outside of steps 1, 2, 3, and 4. Well, guys, that is our session for today. Appreciate you being on with us, and we will see you next time.